In 1773, the British East India Company controlled more territory than most European nations. It commanded a standing army twice the size of Britain's. It collected taxes from 30 million people. And it was weeks away from bankruptcy. The danger wasn't visible in the company's reach. It was underneath it, in the mechanism holding everything together. At the peak of institutional power, when control feels absolute, the structure becomes invisible. You stop questioning what supports it. You assume strength equals stability. But late cycle dominance operates by different rules. The stronger the position, the more capital required to maintain it. The more capital required, the narrower the margin for error. The company didn't fail because it was weak. It failed because the system designed to sustain it could no longer bend. And the danger wasn't in the price, it was underneath it. If this walk through financial history sharpened how you understand risk, take a moment to like the video. It quietly tells the system this work has value. Now, back to what broke. Picture London, 1600. A group of merchants receives a royal charter, granting them exclusive rights to trade with Asia. They pool capital, they purchase ships, they establish outposts in India. It begins as commerce. Within decades, it becomes something else entirely. The East India Company doesn't just trade, it governs, it taxes, it wages war. It becomes a sovereign entity with its own currency, its own military, its own legal system, a corporation operating with the authority of a state. At the time, this looked stable. What no one questioned was the structure holding it up. The company's rise wasn't accidental. It solved real problems. British merchants faced a critical disadvantage: distance. The journey to Asia took 18 months. Capital sat idle for years. Risk was enormous, so they innovated. They created the joint stock company, a mechanism that allowed investors to pool resources without committing their entire fortunes. Risk became transferable. Capital became liquid. Suddenly, enormous ventures became possible. The model worked. Ships returned with spices, textiles, tea. Profits multiplied. But success created dependency. The British economy began to rely on Eastern trade. The government relied on the company's customs revenue. Investors relied on dividends. And the company relied on a single quiet assumption, that it could always access credit when expansion required it. The entire structure rested on uninterrupted liquidity. It worked, but only under conditions that would not last. Between 1757 and 1770, the company transformed from a trading entity into an empire. After the Battle of Plassey, it gained control of Bengal, one of the wealthiest regions in the world. Tax revenue flooded in, territorial expansion accelerated, stock prices soared, London celebrated. Investors grew wealthy. The company became Britain's most powerful institution. But expansion demanded infrastructure, roads, forts, administrators, standing armies. Each new territory required immediate capital outlay, with revenue arriving years later. The company began borrowing heavily, not because it was failing, because it was succeeding. Growth required liquidity. Liquidity required debt. Debt required confidence, and confidence required continuous growth. An unintended consequence emerged. The company became structurally dependent on investor appetite for its bonds. Deferred risk accumulated in the plumbing, the credit markets, the bond rollovers, the short-term borrowing that kept operations fluid. On the surface, prices improved. Underneath, the plumbing tightened. By 1769, subtle fractures appeared. A famine in Bengal devastated tax collection. Revenue projections collapsed. The company needed to roll over maturing debt, but investors grew hesitant. Bond yields began to rise, not dramatically, just enough to tighten margins. Management faced a decision: slow expansion or increase leverage. Slowing meant admitting structural vulnerability. Markets punished hesitation, so they borrowed more. The company issued new bonds at higher rates to cover old obligations. This created a second-order problem. Rising debt service consumed an increasing share of revenue that was now unpredictable. Early warnings appeared in the credit markets, not the stock price. Liquidity became expensive. Refinancing became frequent. Nothing collapsed. And that was the problem. When systems deteriorate slowly, institutions adapt rather than reform. Each quarter, management believed conditions would normalize. Each quarter, they borrowed a little more. Pay attention to this part. The mechanism that enabled the company's rise, unlimited access to credit, was quietly reversing. But because stock prices remained elevated, no one treated it as systemic. In 1772, a banking crisis erupted across Europe. A major Scottish bank collapsed. Credit markets froze. Suddenly, the company couldn't roll over its short-term debt. This wasn't about mismanagement. It was about structure. The company had built an empire on the assumption that liquidity was permanent. When that assumption broke, the entire edifice destabilized. In June 1773, the company formally requested a government bailout. Parliament faced an impossible choice: let the company fail and risk financial contagion across Britain's economy, or intervene and establish a precedent that private institutions could socialize losses. They chose intervention. The Regulating Act of 1773 restructured the company's governance and provided emergency credit. But the rescue came with conditions: government oversight, restricted dividends, political accountability. The company survived, but it was no longer sovereign. From this point on, the outcome was no longer optional. The structure that allowed a private corporation to operate with state-level power had reached its limit. The bailout didn't restore independence. It transferred control. Over the next decades, the British government gradually absorbed the company's functions. By 1858, after the Indian Rebellion, the company was dissolved entirely. Its territories became the British Raj. Its army became the British Indian Army. The empire remained, but the corporate structure disappeared. Who benefited? The British state consolidated control over India without the political liability of corporate mismanagement. Investors, particularly bondholders, were made whole, preserving confidence in London's credit markets. Who absorbed the cost? Indian taxpayers funded the transition. The company's debts became colonial obligations, and the precedent was established. Systemically important institutions operate with implicit state backing. This wasn't a moral judgment by Parliament. It was structural inevitability. When private leverage grows large enough, it becomes public risk. The financial architecture of empire had shifted. Power moved from chartered corporations to sovereign governments, not through revolution, through refinancing. If you value analysis that treats financial history seriously, subscribing simply ensures you don't miss work like this. The East India Company's collapse reveals something uncomfortable about late cycle systems. Institutional strength and structural fragility can coexist, hidden by complexity. This pattern repeats, not in identical form, but through identical incentives. Consider the rolling top framework. When an institution becomes dominant, capital concentrates, risk becomes opaque, flexibility diminishes. Success creates the conditions for rigidity. The company's stock price peaked years before the liquidity crisis became visible. Prices are the headline. Plumbing is the story. Modern markets operate with similar dependencies: corporations reliant on rollover financing, governments dependent on bond market confidence, investors assuming liquidity is permanent. The mechanisms differ, the structure rhymes. Late cycle psychology follows predictable patterns. Incremental leverage feels safe when conditions are stable. Credit market stress appears manageable until it compounds. Institutional assumptions harden into systemic vulnerabilities. This isn't a prediction, it's pattern recognition. History doesn't repeat events, it repeats incentives. The question isn't whether stress will emerge. It's whether systems retain flexibility when it does. Positioning matters more than forecasting. Understanding plumbing matters more than predicting prices. Awareness of structural dependency matters more than tracking headlines. You don't need to predict the crisis. You need to recognize when flexibility has quietly disappeared. Well, 2 takeaways. First, about systems. Institutional dominance creates hidden fragility. The mechanisms that enable expansion often become the constraints that limit adaptation. Late cycle strength isn't measured by control. It's measured by flexibility under stress. Second, about behavior. The most dangerous assumptions are the ones no one questions. When credit feels permanent, when growth feels inevitable, when institutional power feels absolute, that's when the structure underneath deserves the most attention. The East India Company didn't fail because it was reckless. It failed because the system it relied on stopped bending. And no one noticed until the structure had already locked. You can't predict when plumbing breaks, but you can recognize when it's tightening. That's not fear, that's awareness. If this helped you see the system more clearly, consider liking the video and subscribing. Not for predictions, but for perspective.